Hey, everybody, welcome back to another episode. I'm your host, Brandon Cobb. I've got a very special guest here today. It was funny, I was actually having dinner with him a couple weeks back and didn't even know he was scheduled for this podcast. So, this is super cool. I've got Eddie Speed today. He's got over 40 years of mortgage note investing. I don't know many people who've been in business for 40 years, let alone done the same thing for 40 years. So he's got some highly specialized knowledge that I am really excited to share today, especially where we are. It's November of 2025 right now. It's been a very difficult market, but he is in an industry that has really done well. And I'm going to let him speak to that and kind of dig into this. If you've got any kind of portfolio right now, and you're looking to invest in real estate, like I would highly agree that mortgage notes probably need to be part of that portfolio. And we'll kind of go into some of the reasons why and have a little bit of fun with it. But first, Eddie, welcome to the show.
How are you?
I'm fantastic. How you doing, man?
I'm good. Good to see you again.
I know it is good to see you
Yeah.
again. It was funny. We were chatting about AI and blockchain and notes going on blockchain and stuff at dinner. And this is really cool. I don't know if we'll have time to talk about all that, but I want to first get into how did you get into the note business? And then the part two of that is why did you stay into it for 40 years? Because I see so many people get burned out in a particular industry, or eventually something happens and the market turns and they go bankrupt. Like 40 years is a long time. Like, how did you manage to stay in it and continue to enjoy it for that long?
Well, I'll talk about how I got started first. I was not officially dating my wife at the time, but I knew my wife. We were friends, and so I went to their house on a Sunday afternoon, and his family there and some other friends, just typical Sunday afternoon thing, and they're gonna make ice cream, so to speak. And I sit down at the table, and her dad had been a real estate investor. He was a fireman, and he'd been a real estate investor, and he'd bought foreclosures, and he had built houses and had rentals and all that stuff. And he starts telling me about buying notes. And in 1980, that became a thing because notes do really good in inflationary times, right? Because you make more money being the bank than you do a landlord, right? Look at landlords. Houses used to make about 8% a year, Brandon. Now all of a sudden, same house makes 4% a year. This is before you make your payment to the bank. And it's because that rents are not pacing with inflation. And
Mhm.
the expenses on rentals have gone up 2.5 times higher than the rents have gone up, right? So that's the problem, and that was the problem back then. And Mr. Shoemake, my wife's dad, he introduces me to this business and says, "Hey, if you want to know more, meet me at the office at 6:30 in the morning." And it was kind of testing whether I would really do it or not. And I had to rearrange some stuff, but I did. And then one thing led to another, and I, in 20 years old, 1980, I started stumbling into this business of buying notes. I didn't have a financial background. I wasn't some Harvard MBA type, and but I got fortunate to get connected to the right guy. That bit later became kind of my idea of wanting to build a school out of this because I just realized I just found it accidentally.
Why do notes perform well during inflationary times? Because my knee-jerk reaction, and I've not ever invested in a note, but I would think, okay, if I'm the bank on something, my payments are fixed. In an inflationary environment, like if I'm getting a fixed payment on something, the asset's increasing in value, but the loan is not. So
Brandon,
how
I'm gonna tell you something. That is, you're repeating what is all in social media. That rentals are the right thing to own in inflationary times. That's people that's never owned rentals in inflationary times. Because anybody that's ever really done it, that's got some gray hair, will tell you that your expenses far outpace your rent increases. So
yeah.
rentals are making half the net profit they were making in 2018. So you could buy a house in probably 80% of the cities in the United States in 2018 if you paid cash, and you could net 8% a year. It's called a cap rate, right? Capitalization
Mhm.
rate, right?
Yeah.
Now you take the same house and go ask any of the smartest, best, fractional CFOs that specialize for real estate investors. Go ask Marcus Krigler, go ask David Richter, people that have hundreds of clients that have rental portfolios, and they say they're making four now. They were making eight, now they're making four. So it's a
Yeah.
myth.
Yeah, because the price of homes have shot up so much, but the rents haven't followed the price of the homes.
The problem is inflation. The problem is expenses have outpaced the rent increases. That's the problem. Now, and look, who's making more money on a rental today? Oh, I don't know. Let's do some math. A landlord's making 4% and the bank is charging 7. That doesn't seem like good math.
Yeah. So let's do an apples to apples comparison here because I think everybody, it's funny, a lot of people, especially when they get into real estate, they get oh, I'm gonna go get mailbox checks from my single family rental portfolios and it's mailbox money. No, it's not. Like I've got single family rentals. Even with a property manager, it's still a lot of work. It's still management. Stuff goes wrong. Things get expensive. Comparing these two, we've got a rental property, and let's just, for math purposes, let's keep this really simple. Let's say it's a $100,000 rental property and it's producing $4,000 per year, 4% cap rate, current market conditions.
Yep.
And then we've also got a $100,000 note
Yep.
on, maybe it's on the same property, maybe it's not. Like, what does that look like? How does somebody compare that rental property to a note?
4%, 10%.
Why is it 10%?
Because you can make 10% a year on your investment with a note. And
How
you get
does that work?
4% on your investment because we're buying notes that yield in the marketplace 10% a year interest income.
Okay, so there's already an existing loan. Let's say it's on this particular rental property. You're
Yeah.
saying that there's loans out there that are already in place that are paying a 10% interest rate because
I have 100 under contract almost all the time. So
I see.
almost
And
every day in my office, when I walk in, it says how many loans are in the pipeline. This morning it said there were 112.
are these loans that are made by like bank? Because when I think of like a bank loan, I think of like a lower interest rate. When I think of a 10%
We're
interest
not
rate, I
we're
think
not
like, oh,
buying
this is a
we're not buying Fannie Mae loans, okay? We're buying seller finance notes. But I've done this for 45 years. I've closed well over 2,000 portfolios of notes. And so we've learned how to grade these notes and run a risk scale over the top of these notes that they perform extraordinarily well and they just have a higher interest rate. And I'm a
okay.
specialist. If you looked in the whole United States and says, who's a specialist at buying portfolios of seller finance notes? If you were a guy that had 1,000 notes, and you said, who do you know of out there that's like a specialist and that really has a long, measurable track record in buying portfolios and notes? Eddie Speed's company. That's what people would say. Like I'm in a very small world business, but we're very small. We're a well-known fish in a small pond. How about that?
Okay. Yeah. Which is what you want to be. So you said that the majority of these are seller finance notes, which means the landlord owns the existing property and
He's
has
not a
finance.
landlord. He's not a landlord.
He's not a landlord.
He's a
He's a
bank.
he's a he's a
He's a
he's a
bank.
bank.
He's
Yeah. So
seller financed that he's carrying financing. He's not a landlord. He's a bank. Now I can
right. Yeah,
show a
I'm sorry.
landlord how to convert to a bank.
He owned the property at one point free and clear. And then what he did was he said, you know what? I want to sell my property on seller finance terms to my tenant, maybe who lives in it or someone that wants to buy it. He got a small down payment or maybe no down payment, and he's getting those monthly payments.
We are showing people how to convert rentals today, but a low percent of those people that are converting rentals are actually selling to their tenants. Most of them are selling to a new buyer, right? Or we're showing people that are buying properties and reselling with seller financing, particularly very super effective in the Hispanic world. Not exclusively, but Hispanics are people that we're not talking about illegals. I'm not talking about somebody that's going to get picked up by ICE and hauled off. I'm not saying, but I'm just saying that's a particular market that really glows and does well in this. And I buy those kind of loans all the time. I've got, always have got, and these are deals that like, we help our students figure out how to buy them, and we've built a whole marketplace around that, right? But you're saying, well, I didn't think people you could get that kind of interest, and that is you asked me a question way back, and you said, "How have you loved doing this for 40 plus years?" And the answer is, you see a smile on my face. I have found that rent houses suck the life out of people, and notes pour the life into people.
Hmm.
I mean, if all things were equal in the math, Brandon, which would you rather be, a landlord or the bank?
Oh, the bank. They're the biggest
I've
buildings
asked
in the
that
country.
coast to coast and probably to audiences totaling 200,000 people. I don't ever have somebody go, "Oh no, I'd love to be the landlord." Why you want to keep smiling? Get in the right business.
Yeah. So, how do you find these seller finance notes? Because it sounds like that's the majority of the business, it sounds like.
We are specialists in buying portfolios of seller finance notes. You go to Collective Genius, you go to Boardroom, you go to Investor Fuel, you go to Tom Kroll's event. They say, if you said, "Does anybody know anybody that specializes in buying portfolios of seller finance notes?" And anywhere in any real estate network you can think of, and they'll be like, "You ever talk to Eddie Speed?"
Mm. Okay, so it's networking. You've just built a brand and a reputation in this industry. Because I guess a lot of people might not know who. Because like I know a gentleman here who has a portfolio of properties, and quite a few of them are seller finance. He might not know that he can sell, his notes. Like you're dealing with a client that has to have knowledge that you exist and you can help them. In my experience, a lot of these, I'd say like retired landlords that are seller financing properties, they don't know that they can like bundle up their properties and sell them as notes. They don't know that they can do that.
Yeah. Well, um, that's true. And we do have, some outbound marketing that we do to kind of make sure that we're not, hopefully not missing that guy as well. But if they have a specialist servicer, if they have a specialist insurance group, if they're in some kind of mastermind or they know people that are in masterminds, we've spent a lot of years being recognized as the people that do this,
Mhm.
right? And I regularly speak, like you saw me speak on stage the other day. I regularly speak to audiences, and just think about it, Brandon. The people you're talking about, in conversation now, you'll be like, "Have you ever thought about selling any of your notes? And have you ever like, do you know who Eddie Speed's company is, Colonial? Have you ever encountered them? Like, it becomes a conversation, and there's about 100,000 seller finance notes a year created.
Mhm.
Okay.
Wow.
Um, we think we're targeting 20,000 of those 100. What do you mean? Not everybody that creates seller finance notes creates a note good enough for us to buy. So
Okay.
we have a particular grade of note we're looking for. So some people
That's
seller finance stuff that's what we kind of think is junk.
Okay, so let's break this down into the key variables that you are analyzing on a note portfolio. Here's how my brain would look at it, and I'm sure you're going to tell me the right answer. If I was looking at a portfolio of notes, there's certain key variables that I want to look at, like the credit score is probably going to be one, and what's the loan to value, on the property is going to be the second one. So I've got a list of these items, but if it's thousands of properties or hundreds of properties, and I don't have a team to go and underwrite every single one. I might try to take like the blended credit score or the blended loan to value and look at it through that lens. What are those variables that you're looking at, and how do you underwrite those portfolios for risk?
Let's just start out with making it really simple. Is the property that they sold, is the property that the buyer is buying, is it good property? Is it some desert lot that you can't develop? Is it some house in the ghetto? Is it some house in terrible disrepair? How is that working class person going to go fulfill their dreams on that property? If you can't check yes in that blank, then I don't look any further.
Okay, so that's the
Right?
first check box. What
That's the
about the
first
second?
checkbox, right? What is the quality of the property? Because I found out people don't pay for crappy properties,
Yeah.
right? That's experience. Experience trumps logic, by the way, right? Second thing is, why do I believe they will continue to pay promptly on time? Like that's my litmus test. And you said credit score. Okay, well, what if they have 4 year seasoning? Credit score is important if they've already proven they'll pay and they paid for 4 years. You see what I'm saying? In other words,
Oh,
there's a oh but this and oh but that. So I get to a more simpler get to the simplest way that I can think about it. Why do I think they'll continue to pay? This is our underwriting logic, right? Well, their credit scores got not perfect, but they've paid. They've got a perfect pay history for 4 years, right?
okay. Yeah,
And
yeah.
you said the loan to value. Now, I don't mean that doesn't matter, right? But loan to value only matters in one scenario. Like I don't mean that we ignore that scenario, but loan to value only matters if they default.
Mm,
Okay. So but loan to value matters in knowing whether the buyer has equity in their property,
mm.
right? Let me ask you a question without any numbers behind it. Do you owe the same amount of money on your house that your house is worth?
No.
Okay, your bank has a cushion.
Mhm.
You see what I'm saying?
Yeah,
So
there's equity in on
so
top of it.
so
Yeah.
we take it. I can nerd out and be very scientific with you and all this underwriting blueprint and stuff. And if you came to a class, I actually would probably do that, right? But it's not very meaningful on this podcast, right? Because
Mhm.
like it's like just at the top line, Eddie likes nice property. Eddie likes people that looks like they're going to continue to get what they bought and pay for it. Like they're going to get a piece of property they're going to fulfill their dreams on, and they're going to then have the ability and the willingness to continue to pay. When you
Mhm.
start out looking at mortgages, it's not much more complicated than this. So I'm working on a portfolio right before we did this like literally I'm working on a portfolio and the guy's got a bunch of crappy land that I don't think is developable. I don't think you can put a septic on some of it. I don't think you can get water to it. I don't think you can get access to it. And our team just says, we're just making sure you know we looked at this. And I'm like, no deal, throw it out. He's got
Mm,
500
I see.
loans, not interested,
Wait,
right?
is it just specific to houses, or do y'all do
It's
like land as well?
anything.
Is
We'll
that
buy notes on
anything?
anything. I bought more notes on land and houses than anything else. But I bought a note on everything from a high rise to, a junkyard, right?
Mm,
Most of my target customer today are people that are real estate investors and they're creating notes on houses and land. And I'm in probably three masterminds where there's, you know, the top there's 80% of the top 1,000 house buyers are in one of those masterminds. So I'm in a circle of people all the time that do this. And a lot of the things that I try to help them do are manufacture good notes. So I've built
mm.
systems and processes where we can help them make the note up front so that they make it better and it's more valuable when they go to sell it.
On the back end, you're building your customer base on the front end when they're creating the notes, so that when they want to sell it on the back end, they immediately think of you because you've
Because they
already
don't
added
know how to
value to
make
them.
it look, yeah, they don't know how to make it look like a mortgage bank, and I do.
Interesting. Okay. So that changes the dynamic then. So that's where you're getting a lot of your customers as well. It's in the front end. Like you're educating on also how to create the notes from your rental properties. Okay. That's really interesting. Now, when you create these notes, how do you, like, how does your company profit? Like, how do you guys make money on it? Are y'all like collecting, like I think of like hard money loans where, you pay a couple points to get the loan, like the sponsor who's doing the hard money loan fund, like it's not their money they're lending out. They're just arbitraging the difference between what they're borrowing the money for versus what they're lending it at and collecting like some origination points. Is it similar in this environment where you're going out and buying these loans at 10% and then like selling them at 12% or 8% maybe? Eight, you're buying them at 10, so you'd sell them at 8 and collect like the 2% difference.
Yeah, so we have two internal businesses on the note buying side. I have a training school, right? And I train people how to buy notes. But on the other side, we have an investment company and we buy notes, right? So we have our own family office, our own retirement accounts, our own capital that we invest, and we try to keep that money employed buying notes. But we have more notes than we have money. And so then
Oh,
we, because I mean, we keep 100 and something notes on a contract on any given day, right? So we run out of money, and then we trade notes. And I have Note School does really well at training people that have investable capital, capital ready investors, we call them. And we train them how to go buy a note and be the bank versus a landlord, which is super easy to do in today's market. Like to show you the math and do a risk comparison, to do a yield comparison, to do a stress comparison. Like we're going to spank a rental all day long, right? More profit, way less trouble, way less risk, like all of that, right? So then, though, we beyond that, I have family offices that I deal with. I have hedge funds that I deal with. I have banks I deal with. I have insurance companies I deal with. So I have different kind of people with investable cash in different that come in different ways, right? And so if somebody calls me and they've got a $40 million portfolio of notes, right? I want to go sell 40 million. Well, I may not be able to sell 40 million to my note school tribe, just in 1 week, right? But I can make a phone call and go trade $40 million trade like no problem.
mhm.
So it depends on how much business flow it is and what it is and yield and property type and all of that depends on like exactly where we slot that deal.
Mhm.
But I would say that, the answer is I do love this. You're saying, how have I stayed in it for 40 years? I just would say that I generally, most people that get involved in the note business find it to be very fun. It's, we try to take a lot of stress out of it. Like, so people that come to the school and want to get long term with us and do stuff, like the grind of finding the notes and the underwriting, I've got a really good team that does that. And I'm not kidding you. They're grinding every day. I may not be sitting in my office grinding, but they are, right? I get to go make deals. Like people say, when are you going to retire? And I'll say, why would I retire? My wife loves her house and her yard, and I suck at fixing things. Like, why would I go get that misery every day? Like,
Yeah.
I love making deals. I've been
So,
doing it all morning, trust me,
so
right?
is it looking at it through the lens of just collecting a fee for every note that you sell
Make a
somebody? You
spread.
just collect the fee or you make the
We make
spread?
a spread. We buy $100,000 note and we make a spread, and we have to. We have an overhead, right? We can't do it for nothing.
Yeah. Oh, yeah,
Let's just
sure.
say that we make $5,000 on a trade, and and we sell the note for 105, and that investor then typically averages about a 10% return. So I buy it at a little more of a discount than that.
Mhm.
And listen, I'm making a marketplace. This guy that owns 20 notes does not have 18 investors that would love to buy his notes, and they're trained and have confidence and have a system to go buy it. So I've created the process so that I can take a dentist or a realtor or a, you know, whoever, who all we were sitting at dinner with the other night, right? They've got money. They're not in the marketplace. They don't really know how to do all the paperwork and the underwriting, and they don't have a system to go do it. And then I've created that marketplace and I just hand them a loan kind of with a ribbon on it.
Hmm.
And they're like,
Yeah,
heck yeah, I'd love that more than having a rental.
it's like turnkey rentals, but turnkey notes.
That's basically it.
Okay, I see. Now, talk to me about some of the risks of note investing. Maybe take us back to your first blunder. If you can remember what that was. 40 years is a long time, but I'm just kind of curious. Maybe talk about some of the mistakes throughout your career that really stand out to you, and then how investors can mitigate the risks.
I gave the advice I gave you and how I determine whether I'm willing to work on a note is the best advice I can give you. Don't deal in junk property, and you need to make sure that that buyer can fulfill their dreams on the property, right? That will tell you whether a loan is likely to continue to pay in the future. Now, credit and pay history and equity and all those, I'm not saying they don't have a weighting factor in it, but at the
Hmm.
end of the day, we don't spend 10 seconds looking on a note that we look at it and say, the property is a piece of junk. They're going to wake up one day unhappy and they don't want to pay for it.
Yeah, I
It's
so
an,
I can wrap my mind around the whole it's in a bad area, it's a junk property, it's a lot of work. That I understand, but how do you underwrite whether or not, and I like what you said, whether or not they can make the dream work, right? Continue making the payments
well,
on the
if I'm
property
buying a
and the
loan with no pay history, then I want to see credit is the report card of how they pay others back.
right, yeah.
I want to see their income. I want to see. I'm going to look at them like a bank's going to look at them,
Yeah,
right?
yeah, okay.
And
Yep.
and and so in other words, they don't have a lot of seasoning. I want to see them have some skin in the game, some down payment, probably at least 10%. So there's certain things that I'm really going to look at and say, statistically, those customers are the kind of customers that can pay and they can afford that investment because we see their income and their debt to income ratio and all that makes sense. If I'm buying a loan where they haven't done that level of underwriting, but maybe it's got a 4 year pay history, then all of a sudden, then the fact that they have paid for 4 years and I can go look at the house today and say, wait a minute, are there roses in the flower bed? Do they like living here? Do they look like, you see what I'm saying? In other words, how well have they done with the house that they've bought? And you can
Mhm.
get a good sense of, this is fulfilling their family's needs, right? And so you know, and you're saying, well, Eddie, all you're saying is you're just really describing common sense. That's what I think we are, just common sense note buyers.
So take us back to the market back in 2008. With this simple framework, you had to been looking at notes going, this is insane. I'm not going to buy any of these.
Well, they were going to put me in a straitjacket in 2005 because when I was on stages in 2005, I said lenders had lost their minds. They have flat lost their minds. And what they're doing does not make any sense and it will blow up in their face. And people would go like, Eddie, like they were saying I was an old guy in
Yeah, you
2008.
you were the crazy guy, yeah.
You just don't understand modern day stuff and you're just confused. And I'm like, oh no, I'm not confused. That paper won't pay. And
Yeah.
so when 2008 happened, it was like, of course it was going to happen. Same thing happened in the mobile home business in 2000, right? It's just so all of that was very, very, very predictable market conditions. And
How are you handling it in your business though? Like, for the amount of notes that you had to been looking at and none of them penciled, were you still able to like operate, or did you have to scale down the amount of notes that you were buying and
Yeah,
selling?
so we were talking about this the other night, right? I've had to reinvent myself. So in 2008, I wasn't buying near as many notes on houses and I was buying more notes on land. So land wasn't involved in subprime lending. So people would buy
Right.
country land and go. And so I found a market that was underserved where they were doing good deals to good people. And I let the craziness go over there and I didn't have anything to do with it. Right. And so like you heard me do a presentation the other day at this event and said, like, how have you stayed in business for 45 years? And you really just heard me say, it's like, look, you got to know, you got to have some discernment. You got to have some judgment that says just because people are doing it doesn't make it smart, right? And you have to go find things that says, is this logical? And so, fortunately, I've been influenced by a lot of mentors and people over the years that have had a lot of, but it's always been that don't forget common sense.
Hmm.
And there are markets where people forget common sense. And I'll give you an example. Like the whole thing with all these people and starting in 2021 to say the only thing you should buy is rentals, or the
Hmm.
fact that people were promoting, you could read every market report out there that says the apartment market is headed for hell 2.5 years ago. I mean, trust me, go read the TREP reports, go read the Fannie Mae mid-year reports, like anything out there that like people that were sophisticated and knew what they were doing. They said the apartment market is way overpriced and there's all these problems ahead of it. And I'd go to a trade show and people are like, "We're crushing it doing multifamily." And I'm thinking like, you're either a liar or a fool. I just don't know which. And all of a sudden, everybody's looked up and apartments are down 25% in value. Now, not listen, there's micro markets that's not true. That's like you can't take any market and say it's always true in every story. But generally speaking, we were calling the ball on that way before it happened. And you're going like, man, how'd you figure that out? Listen, have you ever heard of Google? Like it was so easy to find information all over the place that said that market's headed for a rough time. And so part of it is you got to keep your head up. You got to look around, you got to see what's happening. And the thing is, I feel like it's my job because I'm representing a lot of investment dollars chasing this business. I do a lot of market research and I pay attention and I am connected with some Wall Street level guys and they share some things with me that they say this is what people that are making billion-dollar bets, this is what they see. Like, let me ask you a question. How's the residential housing market doing?
No, it's been doing terrible. Yeah, especially since 2012. We had 30 plus builds going in 2022, 2023. They all sat on the market for an entire year with price cuts, seller concessions. And I mean, even right now, uh, there's still distress. I know plenty of hard money lenders here locally that are having to foreclose or they don't want to, and they're just, holding out for them to finish and the property to sell. They're not getting their monthly payments. Yeah, there's been a whole lot of pain.
So you can go look at like trend reports of builder inventory, right? You can go
Hmm.
look at a chart of builder inventory and
Yeah, supply of new houses. Yep.
way back in 23, you started seeing this increase in builder inventory. And then all of a sudden it started going way up in 24. And now by 25, we have the same level of inventory and home builders have the same level of inventory they had in 2009, right? So if you're me, I've been calling the ball on this way before people got hit in the face. It sort of frustrates me that people in this business don't do that
Hmm.
because when I was doing this business in 2088, people didn't have data. You couldn't go Google Analytics or buy reports or like you were just having to gut feel the business all the time.
Hmm.
Today, like there is so much data out there that tells you the trend in the market, right?
Hmm.
And so those are things that maybe it's because I have a school and I train a lot of smart people that like analytics, that like, data and stuff like that. And the school has to be more about creativity than just data. But trust me, every basis of when I decide the direction that I'm taking the business is based on market data information every time. I figured out way over 2 years ago, people aren't making money on rentals. and I was going to figure out a way to show people how to convert their rentals to seller financing and make 2.5 times the net income.
Hmm.
Now I've done that today, but I had to go figure it out. Like nobody, I didn't read a news report and it told me to go do that. But what I was looking for is, I believe the ultimate entrepreneur is somebody that finds a market problem and finds out a way they can solve it. And that's what I try to do in the note space.
Switching gears a little bit, as a business owner who's been running businesses for 4 decades, what have been some of your biggest lessons learned in running a business? And is there like an aha moment where things just really started clicking for you, where you knew you had something special and just things really started to scale from there?
Most small businesses are not tacked down with accounting, been my observation, including ones I've had. And the thing that will get you is when you have bad numbers or you don't know you have bad numbers. And I have found that we tend to be very good at our trade, but we tend to not be so good at the accounting of our trade or having the right accountants or making sure people are giving you the right numbers or making sure you have competency in that area of the business. And I tell people all the time, I've lost way more money on bad accounting than I ever have on buying bad notes.
Hmm. Tell me more about that.
It's just the truth. I mean, like all CPAs pass the same test. Trust me, they don't have the same level of competency.
Sure, yeah. So you hired a
Right.
bad CPA?
There's tons of them out there.
Yeah, yeah.
And
No, you're
and then not understanding the difference between a CPA that's gathering historical data to file taxes and a chief financial officer that's looking at the future and what trends you're going and tells you moves to make. So I there's a much difference between having a chief financial officer or even a fractional chief financial officer compared to having just an accountant. Your accountant is not a CFO, I guarantee you.
no, they're not.
And so these are the things like that you're saying, what are the lessons that kicked you in the head? Those.
I compare financials to the dials on an airplane. That pilot is literally flying blind without those dials, especially at night. They don't, he could be nosediving for all he knows if he doesn't have the altitude meter, the
Yep.
air pressure, all these things. And the business is the same way. I mean, it took us 7 years before I realized what a cash flow statement was. I mean, which it sounds insane, but I don't know how we operated that long without a cash flow statement of everything coming in and out and all the developments and the everything in one space where we could kind of look at it. It really is important. In fact, in our coaching community that we have, one of the first things we do with our students is we look at their cash flow, and most of them don't have one because we can see where the low hanging fruit is, where the lower expenses, or maybe they're paying too much in interest on their loans, whatever that could potentially be. Like, we don't know
Yeah.
what the business looks like without that cash flow sheet. So I understand. I hear where you're coming from on the financial side of things. So that was a big lesson learned. What else comes to mind?
Well, I mean, I guess I just had a rant over it, right? It's like people not knowing market conditions. Like, like today in 2025, you getting market conditions. And first of all, it's like, who do you listen to? If I don't, I'm sort of saying this somewhat disrespectfully, okay? I don't need to go to Facebook and hear somebody's hot sports opinion about what they
Yeah,
think the market's going to do because they do not have an IQ test to have a Facebook account, right? And
yeah.
I can tell you right now that I see people say stuff on a regular basis on Facebook, and I'm like, that guy is a fool.
Well, what I use
But
social
people don't
media
know
for,
that, like people, the guy states his opinion, and it's all this and that, and you're like, whoa, what happened?
yeah. I'll
And
tell
the
you
answer,
what social media has been good for me though is gauging retail sentiment on something. Like when markets get particularly frothy, like I saw something on the news the other day with gold. I had some gold silver. I
yeah,
sold it a little bit early, but I had some physical silver. There were people lined up to buy physical gold outside of the bullion stores, like around the corner in New York and London. I mean, it was crazy. And everybody on social media was talking about how gold was going through the moon and everything. And I was like, oh, That's the herd psychology. I need to get out.
Yeah, Warren Buffett is the best at calling that, right? It's saying that he's a contrarian market and stuff. So once again, part of it is that I'm a specialist in uh, specialized notes, seller finance notes. So I'm not really a specialist in Fannie Mae loans. I mean, I may know more than the average guy walking down the street, but that's not really my space, right? That means that I have to know something about real estate and something about real estate operators and something about market conditions. I have to be able to read when the market is, got troubles ahead and that type of thing, because that's my collateral. And by the way, that's the guys that the operator, the guy that's the real estate guy that I'm going to buy notes from. I have to be able to forecast that and see the future. And once again, there's going to be somebody listening that's in a market that's still really good. The Northeast is hot.
Mhm.
You know, Columbus, Ohio is hot. So they're going to say, like, that old man is crazy. He doesn't know anything about what he's talking about. We're killing it up here. And the answer is there's always differences in markets. But generally speaking, the resi market has some kind of rough times up in front of it, right?
Mhm.
We've got about 135% year over year listings. We've got 1,200,000 loans that are more than 90 days delinquent. Only 250,000 of them are in foreclosure right now, meaning 800,000 plus are more than 90 days delinquent, but not posted for foreclosure. That's some shadow inventory. By the way, you know how delinquent those loans are? They're almost 800 days delinquent. What? No, Eddie, that's not possible. Oh, yeah, it is too. And then you've got the builder scenario. So you got three pressures on the residential market that, like, I generally speaking, I don't hear a lot talked about in that area, right? Now that doesn't mean that your market, Mr. Listener, that doesn't mean your market's bad. I mean, every market could be different. So, and then we get into, like, just what's going to happen with rates, or what's going to happen with, as you said, other things like gold and silver and that kind of, what's going to happen to the stock market. It's not got good predictions ahead of it. So those are all things that, like, to me today, it's very easy to do that, or find what you think is a trusted voice. Like, clearly there are people that I listen to that I think are a trusted voice, and that they've got a lot of research, and that they are saying things that are very clear. One last saying I'm going to leave you with. A judge told me 40 years ago, I said, Judge, I've met people that are bad at telling the truth, and I've met other people that are good at telling a lie. I said, how do you tell if people are telling the truth? And he said, well, there is a pattern to it. And he said, you can be fooled, but he said the truth has a crystalline ring to it.
A what?
The truth has a crystalline ring to it.
Crystalline ring. I have not heard that before.
I hadn't either. I remembered it.
I love this. Eddie, if people want to learn more about you, learn more about business, learn more about your node school, where can they go?
Well, I want to give your listeners a little, what I call an opportunity class. So it'll last about an hour. And I'm going to really then just take the whiteboard and, like, lay out some things, like show people some things about this business and kind of prove some of the math that I've claimed today and why I'm saying what I'm saying. And so I have given them a special intro. This is a class that we sell, but I've given them a special tool today through you, and they're going to go to noteschool.com/recession. And
Notes, noteschool.com/recession. Okay.
yep, and that's how they're going to get it.
Perfect. We'll make sure that gets posted. It's been a pleasure having you on.
Great to see you.